Welcome to the London Business School webinar series, Leading Through a Pandemic. I'm Julian Birkinshaw, Professor at London Business School, and I'm your host throughout this entire series, which is now in its 6th week. Today, we are focusing on a very hot topic, the economics of a pandemic, which is a comprehensive piece of research that my two economics professor colleagues, Andrea Galeotti and Paolo Surico, have been working on for the last few months. And with me to discuss this research is Paolo Surico. Welcome, Paolo, to today's webinar.
Thank you very much, Julian. It's a pleasure to be here.
Perfect. And before we get started, just a couple of housekeeping points. First point to note is we are trying for the very first time a live streaming of this webinar on YouTube. And that's largely because Paolo and Andrea have got such a huge following on YouTube that we thought we'd share the work here with them. Now, that does mean, of course, that we have two different audiences. I just want to note that the way that you ask questions, unfortunately, in real time, it'll only be the Zoom participants who are able to actually ask questions in real time using the Q&A function. We've disabled the chat. However, those of you who are joining by YouTube, please do type your questions and we'd be happy to review them afterwards. A couple of other points. First of all, if you want to tweet, please do. Hashtag LBS webinars is what you should use. We are, of course, recording this video and we will be posting it on the London Business School website. Afterwards, I'll give you more details about that at the end. In the unlikely event that we get disrupted and Paolo gets cut off, we will start again in about 20 minutes time with a fresh link, which we will send to all of you who are registered. So that's all by way of introduction from me. And I'd now like to hand over to Paolo to get us started. Paolo, the floor is yours.
Thank you very much. This is a joint work with Andrea Galeotti and part of a sequence of work that we've been doing together for the past few months. It's received support from the European Research Council and the Wheeler Institute. And I want also to acknowledge the tremendous research assistance of Sara Pavlou and Francesco Modeo, which are two students at London Business School, very bright, that we are very proud to show all the strength of our community. So what is today is part of a sequence of economic lecture. We have seen a few weeks ago the excellent webinar by Andrew Scott about long-term consequences for household and firm and about the government position. In a few weeks, we are going to hear a webinar by Linda Yu about the policy response and in particular what's happening in the European Union. Today, I'm going to bridge these two pieces by providing you evidence on inequality and the heterogeneity of the economic cost across society, across firms, across household. Who is the group of society that is likely to pay the highest economic toll of this crisis, and what can the government do about it? To break the ice, let me start asking a broad question about what you think is the major economic issue in this crisis. I have highlighted 4 which are recurrent in media and policy discussion. What has been a major issue? Perhaps the increase in uncertainty, which frees economic activity. Or perhaps you are more worried about the large drop in household consumption. Another dimension is the large number of firms that have already and will file for bankruptcy and therefore might be forced to close. Finally, people talk a lot about the number of laid off and the huge surge in unemployment that will come. What do you think among these 4 is going to be the major economic issue in this crisis? As I always say to my students, there's never a right or wrong answer. So please vote now. I'll give you a few more seconds. And after that, I will ask Sada to kindly share what has been the outcome. Excellent. So we have a majority of people highlighting uncertainty, but also we have a fair share on workers lose their job and people are less worried about consumption. So let me show how actually all of these pieces of information feed into each other and they multiply in a way that I refer to as the cash flow loop or the cash flow spiral. At the beginning, this was just a global supply chain. Something that we have learned in this crisis is what we thought was a global supply chain actually is a China supply chain. This had a disruption on the supply side, but actually the major channel of transmission of this crisis, as you rightly pointed out in your answer, was about an increase in uncertainty. Will I get sick? Will I lose my job? Will my firm, company close down? An increase in uncertainty, of course, discourage investment, both on the firm side, but also on the household side. If you wanted to buy a car, if you wanted to buy a house, if you wanted to add in any form of household investment, you would prefer to wait and see. But what is household consumption? Nothing but firm sale. If household consumption actually is key as well as all the other components, a drop in household consumption is a drop in firm sale. But there are many firms in the economy. We're going to see a lot of evidence based on my own research for which small firms in particular sector have most of their business model very much reliant on cash flow. If they lose their sales, they won't have resources to pay their workers. They won't have resources to pay their supplier. So firms are forced either to close down or file for bankruptcy and to lay off workers. But what is a worker income? A worker income is nothing but household consumption. We are going to see again, based on my own research, that there is a significant fraction of households, especially among renters and mortgagors, which are cash on hand. They consume a very significant proportion of what they earn. If you stop their cash flow of their earnings, they will stop their cash flow of consumption, which will then increase further uncertainty and will stop the cash flow of consumption to firm sale. This will further stop the cash flow from firm sale to worker income, which will further stop the cash flow or reduce the cash flow of worker income into household consumption, into firm sale, and so on, so forth. Just to appreciate how much uncertainty has been associated with this crisis, in this graph, I pointed out to research done by colleagues Baker, Bloom, and Davis, in which they count the number of times that the word economics, policy, and uncertainty have come daily based on 2000 US newspaper. And this index, whenever get high, show you that uncertainty is high, and in those periods, uncertainty is high. Uncertainty is low. Just to give you a sense of comparison, this is how much uncertainty was high at September and 9/11. This is how much uncertainty was associated during the financial crisis. And then this added to major global events like Brexit and Trump election. Finally, in the most recent period, at the end of 2018, all the uncertainty associated with the trade war between US and China. What is notable is that COVID-19 is off the scale. If you thought that September 11 and the financial crisis were big uncertainty shock, those are half relative to what we have seen so far, and probably more is going to come. High uncertainty means that households want to be more cautious in their spending. They want to try to avoid unnecessary spending. But before the lockdown, what we have seen a lot of stockpiling, which is what is here is a graph coming from research based on bank account transaction level data, show how many pounds, dollar in these cases, household in a sample of US household have consumed from January until the end of March. Here, the beginning of the graph is normalized to 100. And what you see is that there has been a stockpile before the lockdown, before having a very, very large decline in air travel, food deliveries, grocery, public transport, restaurant, and retail. Just to give you a sense of this decline, the level that we reached at the end of March were 50%, half of the level of spending at the beginning of January. This is a massive contraction in aggregate demand. Why this matters? Well, this comes from my own research, in which we have the availability of looking at the balance sheet of the universe of private firms in the United Kingdom. Private firms are those who are not listed in the stock market. What you see on the horizontal axis is the size of the firm as measured by asset at book value. And what I have plotted on the vertical axis is the ratio between cash flow to asset. Firms which are small, they tend to have little asset. And therefore, their business model is mostly reliant on the cash flow that they receive through their sales. We have, for a very small firm, actually the value of cash flow can be 2, 3, 4 times as large as the value of the asset. This means that those are firms that have managed to access credit, not because they can pledge their collateral, but simply because they can go to a bank, show their sales and their cash flow, and obtain credit based on that. Those are firms that if they stop selling, if they contract their cash flows, they just cannot operate, almost overnight. Here I have drawn an arbitrary line of 0.5, which means firms where cash flow is as valuable as 50% of the value of their asset. And of course, because of the contraction of demand and uncertainty, the value of their asset themselves is going to go down very significantly. This means that especially small firms will have very little resources, very little asset to pledge, and they won't have any more cash flow because we have seen in the previous graph that households are stopping consumption. How big this effect could be? Well, the small firm in those triangles below the blue curve but above the green curve account for about 10% of employment among private firms in the UK. Bear in mind that private firms in the UK account for about 60 to 65% of the level of employment. We are talking of a drop of 60%, of 6% of employment that could happen and is actually already happening in a very short period of time. The situation is not any better over the Atlantic. This comes from a survey in which US firms, especially small firms, has been asked how much cash would you have and how many months could you survive without cash. Well, I want to bring your attention on the fact that 3/4 of those firms have mentioned that they have only cash on hand to cover expenses for the next 2 months. And there is a large heterogeneity across sectors. Here, firms has been asked, what is the probability that you are going to still be open on the 2020 December as a function of how long this crisis is going to persist. So if the crisis is going to persist only another month, those firms think that they have between 50 and 80% of still being open in December 2020. However, if this crisis will last as long as 4 months or 6 months, which is much more likely given that there is no clear, obvious path towards discovering a vaccine, then the share of firms that believe will still be open in December 2020 drop down significantly. And now the number goes from as low as 15% for services like restaurant, bar, and catering to 60% in banking and finance. So a lot of heterogeneity, but a lot also of extremely low number on what those firms believe is their chances of being alive after 1, 4, and 6 months. We'll say these 2 columns are the most likely of continuation of this crisis. Everybody look at existing small firms. Don't forget that there is another side of the coin which is equally important. Most of job creation in the economy is made by startup. We are going to see much less startup in the next 6 months. We have already hard evidence about this which comes in this chart through the new business application done in the United States. The month of March has seen a drop in new business application of 42% relative to what we have seen in the same month of the previous year. So this means a lot of startups that will not be born, and therefore a lot of jobs that will not be created. And we see already the consequences on this on the household side. So this is the fourth part of the loop. Consumption drop, because many small firms rely on cash flow, they will be forced to close, and new firms will not be open. What does it mean? They need to lay off workers, which what we have seen in the United States. In the last 3 weeks, we have seen a number of 22 million of unemployment claims in the United States. Just to put things in perspective, as we do in this chart, since the beginning of this series, around 1965, the highest peak of this time series has been 650,000 unemployment claims reached during the Great Recession. Now we are a number of 3 million, 6 million, again 6 million and 5 million. This is an order of magnitude higher than anything that we have seen before. Never by historical standard we have exceeded 650,000. Now we are already above 22 million. But if people are laid off, how they are going to pay for their expenses? And again, this comes from my own research, highlighting the importance of housing tenure to understand which group of households are cash on hand. This is based on the UK population. These are numbers that arrive until 2019. Most of the UK households have a house without a mortgage. Then there is another 30% which own a house with a mortgage, and there is a 32% of British households which rent. However, their balance sheet position, which is what we recorded on the left table, is completely different. On one extreme, we have renters. They don't have any housing, that's why you see a zero here, and they have very little saving, very little liquidity in the form of cash on the account or in the form of stocks. Their interquartile range, actually they are in debt. This means that they are paying with unsecured debt, credit card. On the other extreme, we have outright owner without a mortgage. They own a house, and this is their value, but also they have accumulated quite an amount of liquidity in the form of cash or stocks. So they are the ones that are unlikely to be constrained, are the ones that are likely to have more cash in the case they should not receive any more an income. There is, however, on the other hand, renters are the ones cash on hand. They don't have a house, they might be cutting their income because they might lose a job, and if they do that, not only they won't have enough money to pay for their bills and to pay for their grocery, but also to pay their rents. And then there is an intermediate group, which is the one of mortgagors. Those are the wealthy hand to mouth. Why I say wealthy hand to mouth? Where they are wealthy because they own a house, although its value is not as high as the one of outright owner, because they still have to pay a mortgage. But what they've done, as most people have done, they've put all their cash, all their liquidity, to put down as a deposit to get a better product, a product on a better condition. So they are stretched because maybe they have a nanny, they have children in private education, and more importantly, a large share of their expenses is pre-committed into mortgages. That's why we see a very little of liquidity. This is number of pounds, and still there is a lot of variation, with some mortgagors that actually are doing fine, but actually some mortgagors that are already underwater. Why I'm emphasizing this? Because this suggests that there is not only this share of population that might be in trouble if lose their job, they might not be able to pay for their grocery, they might not be able to pay for their rents, but there is also a share within this group that might face a similar problem. They would like to disinvest, but they're not going to sell the house. Who's going to buy now? And still they have to pay a significant mortgage on their house, and if they lose their income, they might struggle both on repaying their mortgage and into pay their expenses. Indeed, the Understanding Society survey in the wave of 2019 for the UK has asked British households How are you doing with your financial situation? What is your self-reported perception of that? And we see that between owner, mortgage owner, and renters, there is a significant share of household in this category that actually feel struggling. 50% of renters is just getting about or find it quite difficult or very difficult to arrive at the end of the month. But there is also 1/3 of mortgagor that feel exactly in the same condition. You put the two together and you've come out that there is 1/3 of the British population that is potentially cash on hand. You stop their flow of income and they are going to stop their flow of consumption, which brings us back to square one of the cash flow loop. What it is, this crisis, is very much a race between supply and demand. We started with a shock on the China supply chain. Intermediate output do not arrive in the Western world, and therefore some firms could not produce at full capacity. This is represented here in a classical economics aggregate supply, aggregate demand framework as a movement of aggregate supply that contract quantity and increase prices. However, the biggest shock of this crisis is possibly associated with the uncertainty coming after that. People do not know whether they're going to get sick, whether they're going to lose their job, whether their family, whether their firms is going to close down. This means that firms do not invest anymore and households try to postpone consumption as much as they can. This generates an even the recession now becomes a depression and prices start to fall. Unfortunately, this is not the end of the story because of the cash flow loop. Household consumption drop and therefore firm sale drop. This implies that they produce less, they need to close down. And this brings aggregate supply further upward shift. But what is firms closing down? It means that many workers will no longer receive their income and therefore they will be forced to reduce consumption even further. This brings in an even deeper depression with prices that are more likely to go down. Can we get a sense of what are the possible economic costs of all these dynamics, of all this race of supply and demand that they search for each other but they don't manage to meet? Well, assume that only the lockdown is only going to last a month, and we have already seen a month of that. And that the drop in economic activity, as we have seen, is about 50%, number which is not implausible given what we have seen. And further suppose that the next month and the following month will have a contraction of economic activity of only 25%. And then I make also the optimistic assumption that in 3 months, everything will be back at full capacity and normal, which again, I believe is an optimistic assumption. If you do this drop of 50% now and 25% in the next 2 months, only these amount to a drop of GDP of 10%. This is humongous. And here I have not even started to compute what are the costs of the cash flow spiral. Well, just to give you an order of magnitude, the Great Recession in 2007 to 2009 amounted to a loss of GDP of 4-5% on average across industrialized economy over 2 years. Here we are already talking of 10% loss of GDP in a couple of months, if not less. Add to that the other 5% that we have seen with this kind of dynamic during the Great Recession, and you have witnessed a drop of 15% of GDP, more than 3 times larger than what we have seen during the Great Recession. And this is still assuming that the lockdown will only last 3 months. I hope I have not scared you. There are things that could be done about this. But let me now ask you a second question to move to the second part of the talk. What is your biggest worry for the future? You and your loved fall sick? Whether you will lose your job, either because you are laid off, you go in furlough, or because your firm goes bust? Or do you think that the biggest worry is that you're going to stay locked in the house for a very long period of time? Or because you think that the lockdown will bring a collapse of the national economy? Please vote now to tell me what you think is your biggest worry for the future. As usual, I will give you a couple of seconds. And now I will ask Sada to show us the result. Interestingly, the economy comes by a large margin as the biggest worry that you have. And I think that you might have been biased by the economic cost I have just showed you. Let me show, however, what are going to be the social costs and what are already the social costs of this crisis and the economic implication that all these might have. Huge surge in mental health. People stuck home. Children around the house. Very difficult to work. Very difficult to handle family dynamics, work dynamics. We have seen a huge surge in the demand for mental health services through hotline, through private company. Clearly, this is a sector that sadly will expand. Another big movement that we have seen has been in the consumption of alcohol. Dramatic increase in people staying home and stockpiling and consuming alcohol. Let me emphasize this is also related with mental health, and this is also related to the possibility of becoming unemployed. What you see on this chart on the right is what is the probability that you self-harm or that you die because each of these causes for a 3% increase in unemployment. This is based on data from on analysis on EU country over the period 1970-2007. A 3% rise in unemployment make it 25% more likely than is going to be alcohol abuse that will lead to a death. And related with alcohol abuse, we have seen a huge reporting of a surge in domestic abuse across the board, whether this is France, Cyprus, Singapore, UK, Germany, Argentina. We have seen increase as large as 30% in reporting domestic abuse, and we don't know how much is yet not reported. This is particularly tough for women that over and above this incredible situation might be facing security, health, money worries, and financial uncertainty in a way that might further inhibit women's ability to leave the house. Children. The government has been a little bit underwhelming on policy on education. We have very solid research on education which surely correlate the quality of house schooling with the background of the parents, in particular income and educational attainment. Children from disadvantaged families, from low-income family, from parents with a low educational attainment tend to do significantly worse in terms of home schooling. If you're worried about disadvantaged children, this crisis will make them only more disadvantaged. Through two channels. The lack of ability of their parents to take care of them relative to the children of rich family, the children of educated family, which can support them much more based on historical experience and evidence. Second, access to internet. Many families, still 10% in the UK, do not have access to internet, and around the world, this can be only larger, especially when we go to emerging market. Of course, who doesn't have internet access or is less likely to have internet access are lower income family, lower education family, and therefore the education gap is going to get larger. Unfortunately, also the income gap is going to be large. What you see on the right of this chart is what is the fraction of workers in the United States that can work from home. The green triangle is the millions of people that they are. The blue dot is how many of them can work from home. You can see that there are type of profession, offices, sales, transportation, construction, manufacturing, that just can't work from home. In education, in financial services, we are much luckier because a good share of us can actually work from home. If you look across the income distribution, this is even sadder. Only people at the top of the income distribution are very likely to work from home. 61.5% of them can work from home. But at the bottom of the income distribution, less than 10% of workers can work from home. They are more likely to be put in furlough, they are more likely to be laid off, they are more likely not to be able to work. So the income inequality is going to increase. And there is also an inequality of opportunity in productivity. The more skilled you are, the more are paid, and the more you are paid is because you are meant to be more productive with more skills. But again, are the higher skilled people that can work from home. The low skilled people have jobs like assistance, administration, retail, transportation, construction. They simply cannot work from home. And we are seeing already these on hard data. If you see the hit where we are seeing the largest drop of employment, this is exactly among the low skilled and the middle skilled, much more than we are seeing at the high skilled. So depending on how much income you have and how much skill you have, you are going to experience a very different performance during this crisis, with the skill gap getting larger, the income gap and the education gap also getting larger. Which brings me to the last question of the talk. Given what we have seen on the economic cost and the social cost, which also have economic cost in the medium to long run, so the economic cost is more the short run, but the social cost will have a larger impact on the medium and long run than they will have in the short run. What do you think should be the government priority? Should make sure that household gets sufficient cash? Or should focus on firms receiving sufficient cash? Or should we try to keep workers, even if in quarantine or laid off, to receive their salary? Or concentrate on the financial system so that it can support banks that can continue to lend to firms? Please vote now to let me know what you think should be the government priority. Let's take our usual couple of seconds, and I will ask Sada to share with all of us the outcome of this vote. Interesting, there is an even split, but clearly banks are considered to be particularly important, and workers seems to be crucial in this. Again, let's take a look at what the government has done and what the government could do. If you look across the government, and Linda will talk more about this, everybody across the world is devoting a lot of effort in government spending on public health, expanding capacity, buying ventilators, masks, gowns. Several governments are also using tax reliefs, tax cut, tax holiday, tax incentive, credit condition, credit at better condition. I don't think this is going to be very effective. The problem here is not to incentive people to spend and to borrow. Those people do not have cash to spend and to invest. So the incentives are likely to be less effective if they don't have the resources to spend. What I believe is crucial, as you pointed out in your votes, is to give cash to people that can and want to spend. How can you do that? In the form of tax rebate, even going to temporary universal income. We have talked a lot about universal income. We know that it's very hard to finance this in the long run, but this can be temporary. Or providing cash grants to firms. Direct line of support, not through the banks that might don't have the right incentive to lend if they think a firm is in trouble. But the government could be rescuing directly that firm, for example, using HMRC to revert the flow of payment that so far they always have received inside. Now they can decide to revert to pay outflow in the form of cash grant. This has been used a lot in the UK. This has been used a lot in the United States, in which the Treasury has paid back household money they have paid in the previous fiscal year in form of tax payment. I think that this is not enough, and a mixture of all of these should be used, not just focusing on firm, not just focusing on household, but if you want to literally kill the cash flow short circuit, you need to do money to to firms, but make sure that they only get it if they use them to pay their workers' salary and not laying them off. And then giving money to households, making sure that they spend, going as far as proposing a debit card, a prepaid card with an expiry date, which expire if you don't spend the money that is on that prepaid card by a certain period. And of course, central banks have a lot to play with cutting interest rate, launch QE program and financing scheme, and the Bank of England has done a lot of that. So let me conclude on what is the mix of recipe that we need to hope from the government, which have moved to some extent, not all the way, towards this prescription that we formulated more than 4 weeks ago. Government intervention needs to be now and needs to be massive. Ideally, in the same order of magnitude of the crisis, 1 to 1. If you expect 15% of drop in GDP, you should do a 15% increase in government spending. That's what the UK government has actually announced 3 weeks ago. This is yet to be announced by the European Union, which, however, is moving in that direction. Of course, start from health expenditure. Life losses is extremely important both for society and for economics. Expand supply, test, contact tracing. The goal is to avoid the second peak that will arrive in autumn 2020. Remember, contagion and suppression policy do not solve the problem, they postpone it. They are a good idea because they buy us time, but we need to make the best use of that time to expand capacity and to get prepared to the very likely second peak. In terms of economic policy, target cash disbursement directly to household and business, and if it's necessary, bypassing the bank, directly crediting account of firms and business. Government will need to expand their borrowing at an exceptionally high level, as we have seen over the last 200 years, and Andrew Scott has a fantastic line and piece of research on that. So we will need a strong coordination at 2 levels. Between fiscal and monetary policy, government needs the full backing of central banks, and it needs to be global. In an internet-connected society in which my demand depends from your supply and your demand depends on my supply, no country can stand alone by itself. The UK can do nothing if you try to offset the national demand component of its 15% drop, if there is a rest of the world that is also dropping by 15% of GDP and therefore will no longer demand British product. It needs to be much more coordinated at the international level. And if all of this will be done massively, and now, then we have some hope that everything will be all right. And I want to leave you with this message of hope coming from this rainbow that has been all over around Italy at the beginning of the lockdown.
Wow, thank you, Paolo. Terrific stuff. And it is kind of interesting for me, I mean, many of the audience as well who've been watching all these webinars, because Andrew Scott, our colleague 2 weeks ago, painted, I would say, a much more optimistic picture. And you went a little bit gloomy on us, and I think your story is a lot more pessimistic, but I'm glad you kind of finished on that optimistic.
But you're right, but as I always tell to my friends and colleagues and students, it always depends. This is the gloomy scenario if the government will not do enough. In fact, I think there is enough ammunition out there to revert all this trend.
Good. So let us dig into some of those questions. Just to give the rest of the audience a flavor of, I mean, I've had lots and lots of questions, about 70, I believe, which is maybe a record. There's about 1,800 people on this live webinar through Zoom and many others, I suspect, through YouTube. So I won't be getting to all my questions. I apologize in advance. We're going to go back to the beginning. You showed us that uncertainty graph with, of course, the spiking and bigger spikes as we get closer to the present day. Lots of questions on that, lots of questions on it. Let me just ask one of them. Is media and connectivity adding to the uncertainty? I mean, it's almost taken as read that the numbers rise in absolute terms, but are we kind of talking ourselves into even greater difficulties?
So Absolutely, there are two amplifying effects. As you have rightly pointed out, you can see a trend towards the end in that in that time series. One comes from the increasing connectiveness. You can see this already in financial crisis, which probably was the first recession in real time that we have observed. This one can only be more because everybody's affected, everybody's talking about it, everybody's working on it. So surely there is a big element of that. But also I want to point it out that even before this crisis, you see an increasing trend over the last 2-3 years. This is the years of populism. This is the year of anti-globalization sentiment. This is the year we used to thought as politics, policy, solving the economic cycle. And now we are talking of economists trying to fix the political cycle, in which there is politics and policy, they are generating recession that could have been unavoidable. Just to make an example, look back at Brexit. I want Brexit back. I love the time in which we were talking of this tiny issue, and the risk of the recession were so small, and the number were so small, and we have lost 2 years, an incredible amount of time. When the big issue comes, this is where we should come together.
That's right. No, indeed. I mean, it does really put that whole Brexit debate into perspective when we see what real economic and political turmoil looks like. So, next question. Has the rise of private equity and leverage exacerbated economic fragility? And I guess the very specific questions that follow from that is, are we going to see firms starting to actually put a whole lot more cash reserves onto their balance sheets as a way of surviving future downturns?
So we have seen a lot of recapitalization done as a response to the financial crisis. And I think it's fair to say that especially banks are now in a better position than they were in 2007. Still, the scale of these is so incredibly large that I think it's something that no stress test can prepare you for. And let me also emphasize that the big issue in my mind is not about large firms, which of course are also important, but here is how to rescue those small firms that I've showed you, and that actually are the heart, are the engine of job creation in the economy, and are the one that they start the cash flow loops. So that one are never going to be prepared with enough equity into their business model, and they are extremely reliant on cash flow. Those are the most fragile. And I also wanted to show fragility on the household balance sheet, which is often overlooked.
Good. So there was a follow-up question around small to medium-sized companies. Because so many of them are in trouble, will we see greater consolidation? Big companies buying up smaller companies merging with each other as a means of survival?
Our advice with Andrea to both the British and Italian government has been more than consolidation, is provide incentive to turn your business. I'll give you a very simple example. A relocation company, a taxi driver company. Now there is no demand whatsoever for that, but still we cannot book our delivery slot for food home delivery. Those are firms that should be incentivized and licensed as soon as possible by the government to move into those other business. Restaurant could be reopened, but only for takeaway services. Lawyers could join government officials to help them to file off this request for government subsidies. So we are going to see, and we need to see, much more of reallocation and retraining of resources. So for example, the government could offer to cover a certain percentage of worker salary, as the British government has done so far, but actually could push that level of support to firm salary to a higher level if those firms decided to retrain their staff and decide to move into a slightly different sector for which now there is much higher demand. What we are seeing among the different sectors is that there is a lot of heterogeneity. Some sectors dropping a lot, but there are also sectors that are gaining. IT, in some retail or home delivery. So this reallocation needs to occur as soon as possible, and the governments need to facilitate that.
Got it. And just on the consolidation issue, I noticed that a UK example here, Deliveroo was being investigated about Amazon potentially taking a stake in them, and the competition authorities were saying, we need to review that. Well, suddenly in the downturn, guess what? You know, they've decided that actually it's just fine for Amazon to take a stake in Deliveroo.
Just to give you an idea, you have seen the shocking number for unemployment. 2 weeks ago, Amazon has announced 100,000 hire.
Yeah.
Of course, there is the issue of competition that needs to be worked out, but the crisis is now. If you know, all those small companies, I'm saying taxi driver company, all these could be easily or flexibly. This is the country of flexible legislation. This is the country of opportunity, of moving fast and flexible, and this could be a fast response.
And it is going to create interesting challenges down the road. I get that.
Of course, especially for regulation and
so
competition.
what's your specific thought on this notion that the government shouldn't just be covering 80% of these loans to small businesses? I mean, you know, you touched on it earlier. You know, obviously, if you allow the government to pay 100% of those loans, then you get the risk, of course, a few years down the road, that there's lots of bad loans that have to be then repaid by the taxpayer.
Absolutely. I mean, this is what we have seen a lot. This creates moral hazard problem. I think that now there are two issues. One that, because it might be difficult at this moment to distinguish the good from the bad company, there is an idea of providing a blanket to rescue as many as possible and then to try to distinguish between the two. But I could not agree more that 100% will just provide bad incentive. It needs to be significant enough that provides sufficient cash flow for those firms to survive, and more importantly, for those workers to receive their income. But it cannot go all the way, because we'll simply generate bad incentive to do something else. We'll just make many firms be able to stay home, do nothing, and to get these, and this is not what we want.
No, hugely difficult. Okay, here's a very different question. How does the government extricate itself from its emergency measures? Is there a risk that we all become a little bit addicted to these measures? And what will the consequence of that be for future business failure and indeed for future entrepreneurship? Any thoughts on that?
This is the problem of moral hazard. And of course, if you do once, business might think that you could do another time, and you break that credibility.
Yeah,
we are aware of that, and these were issues which were very contentious, especially during the financial crisis. Should be bailout bank or not? Here is the same, but it's not bank anymore. Is the convenience shop around the corner, as well as the financial company down there. It's a very complicated issue, and there is no easy answer. But I want you to reflect on the scale and the magnitude we have talked. This is unprecedented. We are talking of economic cost of between 10 and 20 times larger of anything that we have seen before. So I will believe that there is not a strong credibility issue as it was before the financial crisis. Financial crisis, 4.5% of GDP. Now we are talking of a minimum of 15 up to 30, 40%. Those could be the threshold and the order of magnitude to trigger a large policy intervention, but also to make it clear the exceptionality of the circumstances that will trigger that large government package. Good.
So, I mean, linking to that, several questions about debt to GDP ratios. I mean, several commentators, several questioners say, look, during the world wars, of course, we had very, very high debt to GDP levels. What's your thoughts about how high that can go? Are we at, say, unsustainable levels yet?
So to do that, I'm going to bring back my slide. This is an excellent question. And I want to bring you to these excellent pieces by my friend and colleague Andrew Scott that show here what has been the debt to GDP ratio in the United Kingdom since 1700. What I wanted to show you is this level arrive above 200. In 1950, arrived almost to 250. What is extraordinary of those circumstances is that it's the first time that this happened in peacetime. These were the Napoleonic War, World War I and the Great Depression, World War II. But in this chart, there is hope. The government is around 100 now. In very short period of time, it will arrive, it has arrived in the past to 250. However, it took the British government more than 100 years to go back from 200 to 30%, to go back to 250% of debt to GDP ratio back to 30%. And I'll tell you more, not only the credibility of the British government bought a lot of time for the debt to GDP ratio to go down. So there was no need for any crazy and rash austerity that we have seen lately. Actually, credibility can buy you a lot of time, and the UK government has that credibility because it has never defaulted on its debt. But also, second message, most of this reduction has not come with future taxes. Most of this reduction has come out, and Andrew Scott showed very clearly, together with my friend Martin Allison, that this has come out of output growth. Debt to GDP can go down either because debt goes down or because GDP goes up. So putting the right policy now, avoiding future economic cost, could be the way in 20, 30 years to bring down very large debt to GDP ratio that will have to increase. One of the person in the audience asked me, how much? I don't know, but I always remind you, science-based, let's look at the data. The answer to your question is in this chart.
Nice. So several questions asking about other parts of the world. Obviously, you have focused, perhaps because of where you live and where the data is, on the UK and the US. I mean, can you give us any kind of fairly general insights into some of the challenges, either in some of the other continental European countries with very, very different kind of government approaches, for example, to government involvement, and to emerging economies? India has been mentioned by at least 3 or 4 of the questioners. And I don't know how much expertise you have in some of these other economies.
We try to cover as much as we can, but we have, so there is a lot of heterogeneity across European countries in the approach and the solution of what they're doing. In the slides, I remind that this is just an update and a summary of a much larger set, a slide deck that with Andrea Galeotti we put on our website, and there is a link and we update them daily. There you can see a lot of analysis for many different countries in which we emphasize especially the heterogeneity in economic cost, but also the heterogeneity in health policy, in terms of testing in particular, in terms of social tracing. And we see that actually the international evidence is a key part of our analysis, because it clarifies what has been working and what has not been working. So looking at the data across different countries is hugely important at this point, and we do to a lot of extent in our slide deck, exactly to learn or not. What we are light, and not for lack of expertise or time, is on emerging market, for a very simple reason. We struggle to get to the data, and there is an order of magnitude larger problem, which is the lack of infrastructure, the lack of health. There are some emerging markets which do not even have current access to water, to health facility, to hospital, not to speak about internet and homeschooling. On the less negative side, those are countries, especially in Africa, which are used to do with pandemic. But you're absolutely right, emerging market can only be more exposed than advanced economy because they are less prepared to respond to that. And this food supply chain might suffer a lot from that.
And just for the audience's benefit, we will provide the link at the end to the website, which has got all the additional materials that you've been putting together in this area. I've got one final question.
I would like to mention at this stage that because of the importance of international evidence, with Andrea, we have just released on the LBS YouTube channel a lecture 5 of our mini-series of a user guide COVID-19, in which we show how we can learn from the experience of the different countries, and we make a concrete proposal for the government of an extra strategy based on testing and social tracing, how and when. So the interest audience could go there for the international evidence and experience of different countries for that particular topic.
One more question before we close. It's a big question, and unfortunately I wanted quite a short answer. Inflation. Lots of people are worried, of course, that there's going to be rampant inflation as the government, sort of prints money and spends its way out of the crisis. What's your short answer to that big question?
I would have never thought in my life to advise government to print money. That's what we need now. The problem now is deflation, is not inflation. Print money, and when we cross that bridge, central banks have sufficient facility to raise interest rate and to quickly withdraw liquidity to avoid that all that injection of money could ramp into hyperinflation. We know that printing money brings hyperinflation when there is bad government. I don't think it's the case in advanced economy, especially in this country. So printing money now, the problem is deflation. If there is sign of inflation, immediately withdrawn and spike interest rate, and that is likely to do the job.
Good. Thank you. We are going to close there. Before we close, I just want to put up one final slide, just giving you a little bit of information about what we're doing next. We have the next webinar on Tuesday next week. A very, very different set of issues. Professor Dan Cable, who is a very well-known, very well-respected figure on aspects of managing yourself. And he's going to talk about how we can use the quarantine to improve ourselves, our work relationships, our non-work relationships. I'm sure that will be a terrific webinar. So if you're interested in knowing more about that one, about the rest of the series, please do go to the URL linked at the bottom there, london.edu/pandemic webinars. So with that, I'm going to suggest that we close. Thank you, of course, to Paolo and to his colleague Andrea for that fascinating set of insights. I think we had a record number of questions today. I'm counting about 160, of which I asked about 12. So I'm sorry to those who I did not get to. We will close there. Thank you.